please.
All right. Good afternoon, everyone, and welcome to HR Webinar Series Part 3, Workforce Planning Resources, where we're focusing on tax credits. As Carolyn has shared, my name is Alan Brown, and I am the Midlands Coordinator and Business Consultant for the Columbia Area Office. Today, our presenters are Attorney Will Clark with Elliott Davis. Will is a state and local tax professional with more than 7 years of public accounting experience. As you can see from the slide, his areas of industries that he's familiar with are manufacturing and distribution, retail, financial services, and construction. Prior to joining Elliott Davis, Will served as a senior associate in the federal tax practice of a non-Big Four international accounting firm. Joining him is certified public accountant Nick Casino. Nick is a state and local tax professional as well with more than 7 years of public accounting. Prior to joining Elliott Davis, Nick served businesses and individual clients in a variety of industries at a top 15 public accounting firm. We'll hear more from them later. Our objectives today, our session objectives are, we're going to go over a brief discussion about the SBDC and what we do. And then from there, we'll move on to discussion about tax credits and incentive utilization for small businesses. We'll talk about top priorities, and we'll close out with a Q&A. As stated, this is session 3 of a 4-part series. You can check out videos from the previous 2 sessions at the website that's shared there. And our next session will be next Wednesday at 12 p.m., where we'll be talking about maintaining good well-being to drive your business and recruit good talent. So about the SBDC, just like our small business clients, in 2020, we pivoted. I had to pivot, but because of the pandemic, and we pivoted to offering disaster recovery assistance. In the process of doing that, we assisted over 22,000 individuals, entrepreneurs who had small businesses, to address the issues that they were facing, whether they were startups, which last year we assisted, small businesses get started, 143, and we're still assisting them this year. You'd be surprised the number of people that were interested in starting businesses last year and even this year. We also assisted those businesses with increasing their sales by $18.5 million. With that, starting or retaining jobs to execute on those sales plans. We were able to do that to the tune of 3,912 jobs that we helped retain or create. And then financing, over $77.1 million in capital was obtained last year through the clients that we assisted. And then, the final area that we help our clients with is in government contracting. Government procurement is what I like to say. Our mission here at the SBDC is to advance South Carolina's economic development by helping entrepreneurs grow successful businesses. And we focus on those 5 areas to do that: starting, growing sales, hiring, obtaining financing, and when the company is ready, government contracting. We've been in South Carolina for over 40 years. We were one of the original SBDC offices to get started back in 1979. We serve all 46 counties through 4 regions. The University of South Carolina region, which is your royal blue region that's depicted here in the map. South Carolina State region, which is your navy blue section depicted in the map. The Winthrop region, which is your light gray, light green on the map, and then the Clipson region, obviously in the upstate, which is your hunter green, dark green area depicted by the map. And we do that, through 21 centers and, roughly 50 or so small business experts and subject entrepreneurs. And we do it in a number of areas. Business planning or planning in general is one of our core services. We believe that, where the plan itself, the document, can sometimes be static. Planning is a dynamic process and should be ongoing. And as listed there, fiscal operations and market segmentation. What we're focusing on today, out of the things that are listed there, is HR, workforce development strategies. And we, as consultants, serve you and other clients via no-fee private consultation, and those consultations are held in your local areas, through 50 or more business consultants across the state. We also provide educational opportunities for our clients, such as today's webinar, providing you training opportunities to gain the insight you need to grow with your business so that your business can continue to grow as well. As I stated a few moments ago, most of our webinars are recorded, and you can find those on our statewide website. Finally, we help our clients, by connecting them to various resources to help them grow their business, in 5 areas. And so, accounting and finance, HR, fulfillment, IT, those areas are the areas that we have a network of resource partners that we vetted, that we can share that information with you, that you can use to help grow your business. And so some things you might want to outsource. And so through that list, that network of resource partners, we can help you in that area. And you would contact your consultant in your local area for access to those resource partners. But I've said a lot, but what are the results that we get for our clients? And so, we asked our clients what results that we get for them. And this is a client, Harleston Towels, out of our South Carolina state office. The business is Rooting Down Farms, LLC, and the consultant is Jim Johnson. And so the quote reads, "Jim Johnson helped me extensively with applying for a grant from the USDA Federal Development Office. I'll be forever grateful for his expertise and willingness to walk me through this arduous task." And a lot of times that's the work that we do, helping our clients work through arduous tasks to make it seamless and simple for them to grow their business. At this time, I'm going to turn over the presentation to Will. Will, it's all yours.
Awesome. All right. Thank you, Alan. I am going to share my screen and we'll get started. Okay, Nick, give me a thumbs up if you can see my presentation. Awesome. Okay. Well, I would first like to thank Alan and the SBDC team, especially Carolyn, for having us on here and facilitating this. We are very excited to be teaming up and presenting on state tax credits. We are from Elliott Davis. Again, my name is Will Clark. My colleague Nick Cousineau. Both of us specialize in state and local tax matters, and we're part of Elliott Davis, which is a regional accounting and business consulting firm that covers your counties, your states, in the region. So we have offices throughout the Southeast, and mainly we're focused on South Carolina credits and incentives. That's what we'll be talking about today. South Carolina credits and tax credits that can encourage growth and supplement income for hiring new employees. So let's get through and let's get to the meat of the presentation. All right. Let's see here. I can get all my screens. All right, there we go. So the main opportunities we're going to discuss today are the small business job tax credit, the capital investment tax credit. We'll cover a little bit of the port volume credit, as well as the employee retention credit. Now, all of these credits that we're going to be covering today are South Carolina income tax credits, with the exception of the federal employee retention credit. So when we're talking about the South Carolina job tax credit or the capital investment credit, these are South Carolina income tax credits that help you offset your South Carolina income tax liability. As a big, very high level overview, again, let's think about when we're filing our tax returns when it comes to tax season. Everybody hates that time of the year, but you're always filing a federal income tax return for your business, as well as a South Carolina income tax return, because both Uncle Sam and Columbia both want our dollars. So we are talking about job tax credits and South Carolina tax credits that can offset your South Carolina income tax liability. I just want to make sure that's clear. So, big picture, South Carolina's job tax credit is a credit that you can receive that rewards you for creating new jobs at your business. It's as simple as that. The South Carolina General Assembly has a vested interest in creating new jobs in South Carolina. They want to see high-paying jobs. They want to see new jobs created, especially in our rural counties. And so we'll get to that in a little bit, but the credit amounts are much higher in our rural counties than in our big populated Charlestons and Greenvilles. So just keep that in mind, that the big picture is we want to see job growth. We want to see new jobs created, and we're going to reward that by job tax credits, which are income tax credits. So these are statutory credits, and they can offset your income tax liability on the bottom line of your returns. Let's get into the weeds. All right. So businesses that are eligible, corporations, sole proprietorships, partnerships, S corporations, and LLCs are all eligible for the South Carolina job tax credits. All you have to do to be eligible is you have to be a certain type of business, and you have to create and maintain a minimum number of full-time jobs. Now, we're talking about small businesses here. So small businesses, all you have to do is create 2 new full-time jobs in 1 calendar year at your facility. So 2 new full-time jobs. Full-time job is 35 hours or more on a weekly basis. Part-time job would be 20 hours up to that 35-hour threshold. 2 part-time jobs would equal 1 full-time job for our job tax credit calculation. So if you have 2 part-time employees, those would count as 1 job, and then you have to have another full-time employee. You know, you can do the math yourself and figure it out. But the key here is, if you're an eligible business and you have the required number of new full-time jobs in that calendar year, you can be eligible for job tax credits up to $25,000 per employee per year for 5 years. Now, that's absolutely huge. And initially, when we were on another presentation that Alan was attending, Alan and I caught up afterwards, and we discussed it. It is absolutely huge, and this is a game changer for small businesses. And unfortunately, in our practice, Nick and I see a lot of small businesses and medium-sized businesses that simply miss these job tax credits because they are not big enough in size that have a big, robust accounting team or big, robust, tax compliance CPA firm that's handling stuff for them. And unfortunately, this is missed all the time, and people are simply leaving money on the table. You are letting Columbia hold on to more of your hard-earned dollars that you are eligible for if you're not claiming these job tax credits, and if you've hired 2 new employees. It's as simple as that. One thing I'll add, and Alan pointed this out, that this is a good thing to mention, is 1099 contractors do not qualify. These have to be W-2 employees. So if you take somebody that was a 1099 and you convert them to a W-2 in your business, that qualifies. So that's simply by converting them to a W-2. It is a good incentive to make your employees W-2 employees, and it counts for the job creation threshold. So let's get into the qualified business types, because this is key. And a lot of times people are unsure of whether or not their business qualifies, and they don't want to look into it further, and they just sit a pass on it. It is not worth passing on. You've got to dig into the weeds. You've got to get in there and figure out if you qualify. So the qualified business types, you have your manufacturers, you have people that do distribution, processing, warehouse. If you manufacture or process or modify anything, whether it's modifying a non-finished good into a finished good that you then sell, that qualifies. If you do any research and development activities, generally if you're engaged in research and development, that qualifies. Any agribusiness operations in the state and or agricultural packaging qualify. Qualified service-related facilities also qualify. These are generally medical facilities, your doctor's offices, your nursing homes, your home health care qualifies, your skilled nursing, labs, dialysis clinics, any of those things that are medical related, those qualify. Technology intensive facilities, that's generally your IT programming facilities and that type of thing. And then the key here, and the home run that I want to hit home for every single one of y'all on this call, is that any business, any legal business in a Tier 4 county qualifies for job tax credits. So if you are located in a Tier 4 county, and we'll get to it in just a second, the Tier 4 counties are your most rural counties in South Carolina. These are your Orangeburgs, your Fairfield counties, your Dillon counties, Barnwell, Bamberg. If you're located in a Tier 4 county, any business qualifies, and your credit amounts are the highest. If you're in a Tier 4 county, you're getting $25,000 per employee per year in income tax credits. If you don't think your business is in this list and you don't think you qualify, please reach out to us. You have to get into the weeds. You have to make sure you're looking at all sides of things. So, I'd be willing to bet if you don't think you qualify, maybe we can confirm and get in the statute and see if you actually do qualify. But just please reach out, make sure that you're not missing these. These are huge and can make a big impact on your business.
Yeah. Will, I would just say that the big red flag here that you don't see on the list, unless you're in a Tier 4 county, is a retail business. So if you have a retail business, that's probably not going to qualify unless you're in a Tier 4 county. However, if you have a retail business that has a back office operation that does research and development, behind where the customers see, we can, there's definitely ways to qualify.
Nick, and I think you just answered this question. Nancy just asked, what is an extraordinary retail? So I believe that's what you just answered, correct?
Yeah, the extraordinary, actually, that's a technical term, and well, it is truly extraordinary because it is basically for malls, and that was amended to the statute at some point, and there's certain thresholds that an extraordinary retail establishment has to meet, but basically it spells out a large shopping mall. So we generally do not qualify businesses under that qualified business type, but exactly, there are other ways that we can get what appear to be a retail business to qualify as, say, a corporate office facility or have research and development going on.
Absolutely. Yep. Good points there. Good point, Nick. All right, continuing on. Again, small business job tax credit. You need a minimum of 2 new employees in the calendar year at that facility or in that county. One other thing we have to mention with the small business job tax credit is the state of South Carolina also has a vested interest, and they want to see that these new jobs are good paying jobs. So for small businesses, that is those businesses that are less than 100 employees and hire a minimum of 2 to get the full credit amount, to get the full $25,000 if you're in a Tier 4 county. Those jobs have to pay at 120% of the county's average hourly rate. Generally, for these rural counties, you're probably looking at, say, $40,000 or a little bit less for that threshold. It's not incredibly high. The cool thing is that if you can't pay at that $40,000 or if you can't pay at that 120% rate, you still can claim that credit. You just get a reduced amount. So if we're in a Tier 4 county and you hire 2 people and you can't pay them at that 120% rate of the hourly rate, you still get 12,500 per job. So the credit's just reduced. You don't lose the credits, it's just a reduced credit. So let's get into where the counties are, where the counties are, where our tiers are.
Well, real quick, we'll also mention that payroll and salary threshold is, if you hire those employees in the middle of the year, it's a prorated amount. So you don't have to pay them $40,000 for that half year. They just have to be on track to meet that $40,000 on a prorated amount. So obviously, if you hire somebody July 1st, their wage would be, they'd be hired on at a $40,000 wage, but they would only make $20,000 that first year. That's fine.
Yep, and certainly we can help you walk through that. We can help you understand those thresholds for per capita wages. What it is the Department of Revenue publishes annually those per capita wage levels for each county. So each county is different. You know, obviously your wages in Greenville County are much higher than your wages in Orangeburg County or Clarendon County, but each year those are published. And so we have that information where we can reference those and we can tell you what you need to be at for those thresholds. And, you know, sometimes it makes sense to pay your employees a little bit more to get you over that threshold going forward for planning purposes. You know, if you're looking at what your employees are making now and you want to be over that threshold, that's certainly a good thing to have in the back of your pocket to help raise your wages and get those employees paid fairly. So just keep that in mind if you're dealing with needing to get this thresholds. Make sure we double check this and make sure we're looking at them correctly. One other thing to mention is the way to not have to deal with the 120% wage threshold and not have to worry about paying your employees at 120% of that per capita wage level for the counties is if you hire 10 new employees in one calendar year. So if you bring on 10 new employees in one calendar year, you don't have to worry about any wage thresholds and you get the full credit amounts regardless of those wages. All right, I'm going to jump in here and I'm going to let's just, I know everybody's reviewing this table, but again, your tier 4 counties, that's where your credits per employee are much higher. Those are your Bambergs, Dillons, Fairfield, Orangeburg, Williamsburg counties, Kingstree. That's your tier 4 where you're getting $25,000 of income tax credit per employee per year for full-time jobs. Tier 1 counties, your Aikens, your Charlestons, Georgetown, Lexingtons, those are your obviously most prosperous counties, and they are they're doing much better, so they don't have as much of a need for these jobs. Again, tiers 1, 2, and 3, you have to be a certain business type to qualify. And tiers 4, any business types qualify. Any business types qualify. So, if me and Nick were wanting to get adventurous and go open a business, we could open up a convenience store in Orangeburg off of 26, and get the beach traffic and get everybody going to the beach. Maybe make some money off of that one. But any business type qualifies in those tier 4 counties. It's awesome opportunity to take advantage of. Again, we mentioned this earlier. If you don't meet the 120% per capita wage threshold, your credits just get reduced. Another thing to mention is there are some bonuses that you can increase your credit amounts if you're located in a multi-county industrial park. Generally, small businesses are not in industrial parks, but you also may have a small business that is located on a brownfield site. Brownfield is a contaminated site where DHEC comes in and flags it and needs to have a cleanup program. If you're on a brownfield site, you will get a bonus per new job.
Will, and I'll mention on that brownfield bonus credit amount there, if you're looking to move into a recently renovated mill or other older building, a lot of these older buildings are being repurposed and reopened with multiple businesses, apartments, condos, etc. That may well be a brownfield site, and that means that the developer or the owner of that building, the developer of the building had cleaned up whatever contamination was in that, whether it be some sort of chemicals or whatever was in that ground that made it a contaminated site. Check with them, follow up with them to see if there are, if it has a brownfield designation, if that has been cleaned up. We're trying to get the word out to our developer clients to advertise that, because obviously that's a big bonus, but your developer, your landlord may not even be aware if that was something that the jobs tax credit is a bonus for their tenants as well. They're probably aware that it was a brownfield site and they cleaned it up, and maybe they took a tax credit, but they don't often know that they can extend information to you that will then allow you to take a increased jobs tax credit amount.
Absolutely.
Gentlemen, we have two questions. One from Matt Wiggins. If a company had layoffs early in COVID and is ready to begin adding new employees again, would they be eligible? How long do they need to be at a threshold before qualifying?
Absolutely. Nick, you want to take that one, or you want me to?
Yes. Do we want to talk about that towards the end of the jobs tax credit, and then we can?
Yeah, let's address that at the end.
Okay.
I think that would be better.
Well, so another one is, would construction service businesses qualify?
Well, I guess the first question is, if they're a tier 4 county, yes, of course they'd qualify. If they're in tier 1 through 3, there are some exceptions. Like we mentioned earlier, you have to get into the weeds. And one of the exceptions is if you're licensed as a general contractor with LLR. If you are licensed with a general contractor, as a general contractor with LLR, we can get you there. We need to go through the weeds, and we gotta go through some steps, but there is an exception for general contractors.
And then we have another question, and that's from Gary Robinson, who is one of our business consultants out of the Orangeburg area. Does the asbestosis clean count as brownfield cleanup?
Yeah, so the brownfield sites actually have to be flagged by DHEC, which is the Department of Environmental Health in South Carolina, as a brownfield site. And just so asbestos could be designated as brownfield if DHEC has flagged that. That'd probably be a bigger facility where there's contamination. Oftentimes, though, the sites that they flag as brownfield that require cleanup before customers can develop the land, there's going to be chemicals in the ground. Either there was storage of old textile mill chemicals or leakage, or potentially waste that was not treated well, etc. And it's going to actually contaminate the land and the earth, and potentially parts of the building as well that qualify for the brownfield.
Yep, that makes sense. One thing I want to hit home here, and then I'm going to turn it over to Nick. He's going to run us through some scenarios and close us up on job tax credits. One thing I want to hit home here is these are income tax credits. If your business is a pass-through business, what I mean by pass-through business is if you pass through the income tax liability to the individual. So partnerships, S corporations, LLCs, those are pass-through businesses where you issue a K-1 to the partners. Those pass-through businesses, these job tax credits, these income tax credits pass through to the individual owners of that business. So if I have this business and I'm generating a bunch of job tax credits because I hired new employees, those credits pass through to me directly. My wife could be a pharmacist or a doctor, and she could be bringing home a lot of W-2 income that's increasing our South Carolina tax liability. The job tax credits that I generated here with my business offset all of our South Carolina tax liability up to the extent of the credits. They offset that income tax liability. So it's very beneficial for pass-through entities because it helps the individual owners offset that tax liability. The key thing to keep in mind here, job tax credits, they have a 15-year carry forward period, and they can offset up to 50% of your income tax liability in any 1 year. So you have 15 years to use up these credits and offset that tax liability. I think I'm going to go ahead and hand it over to Nick. He's going to run us through a scenario, and then we'll close up job tax credits. We'll cover a few other credits. But once we get done with job tax credits, let's take a pause here and let's take some questions on job tax credits specifically. There's one that we just asked about the transition, laying people off and picking them back up, we can address that one then.
Perfect. Yeah. And just to build on what Will was saying there about the pass-through nature of the tax credits for a pass-through entity, if the business, if you're a new business, you're in the first couple of years of startup, if that business is still losing money or just breaking even or doesn't isn't passing through much income to you, that you're reporting, obviously you're reporting that on your South Carolina income tax return. But if that's not what's generating a lot of your income, maybe you have another job or you have some passive properties that you're collecting rents on. Again, like Will was saying, it can offset your entire, the credits are then applied to your South Carolina individual income tax liability. All right, let's run through this scenario real quick just to illustrate how much credits you can generate. So we got a small agribusiness startup in Orangeburg County. Now keep in mind, Orangeburg is tier 4, and they've been tier 4 for a while. And they are again for 2021. The credit for 2020 or for 2021 is $25,000 per job that qualifies per year. So if they add an average of 4 new jobs in 2020, so if they had all these jobs last year and all those wages were at 120% of the per capita wages of the county, which again is roughly going to be anywhere between, I don't know, $40,000 and $45,000 for most of your tier 3 and tier 4 counties. In 1 year, $100,000 of credits will be earned. So each employee that was hired, you have 4 of them, times $25,000, you earn $100,000 in jobs tax credit. Hey, Will, we got the your screens.
Yep, I wanted to show everybody here while we're talking about it. I wanted to show everybody the per capita income figures, just so we know what we're talking, what you see here. These are these per capita income levels that the county or the Department of Revenue publishes annually. And if we're looking at per capita income level for Orangeburg County, $35,000 is a per capita income level. So you have to take 120% of that. And I don't even have my calculator in front of me right now, but it is not that bad. So again, keep in mind, each county has a different per capita income level. Obviously, York County is much higher than Orangeburg, but all you have to be paying is a little bit less than $40,000 for most of these places, and you're getting $25,000 per employee. I just wanted to throw that out there, make sure everybody understands that that we're not talking about huge. I mean, it is significant, but it's not huge. And each of these counties is different, obviously. So just keep that in mind. All right, back to you, Nick.
Yeah, and since Will, you brought that up, and not to go too much in the weeds, but there is, if you're in one of the tier 1 counties, so if you're in Greenville or Aiken County, you reference the lower of either the county's wages or the statewide per capita wage. And the statewide is almost always going to be lower than some of those tier 1, tier 2 wages. So just keep that in mind as you're perusing that. Anyway, so because the jobs tax credit is earned for 5 years per employee that job is maintained. So assuming that those 4 employees, those 4 new jobs that were created in 2020 are maintained for the next 5 years, that company will continue to earn $100,000 of tax credit for the next 5 years. So obviously everybody can do the math on that one. 5 times 100,000 is going to be $500,000 of jobs tax credit. And that's not, counting if the company hires a 5th employee or a 6th employee. Each of those would then potentially create $25,000 per year for 5 years as well. So even just with those 4 employees in a tier 4 county, as long as those job numbers are maintained, and there's an average calculation on how you calculate if those jobs are maintained, it's $500,000. And those don't again, those don't have to be the exact same individuals. If you have turnover, but you then hire a replacement for that person, generally that job in the calculation that you're required to do, those jobs will have been maintained because it's at the job level rather than the individual, and you can generate this much credit. And again, like Will was saying, these credits can be carried forward for up to 15 years, and they can be used up to 50% of your tax liability per year. I'll also add, these are not refundable tax credits. these are, you can decrease your tax liability by 50% with the jobs tax credit, but the government's not going to send you. So if you generate $500,000 of tax credits, you're not going to ever get a check from the refund of your jobs tax credit, but it will decrease any liability that you are reporting on your either individual income tax return if you're if you want a pass-through entity, or your C corporation income tax liability.
Oh, Will and Nick, that's awesome, man. I wanted a check. From the government. That's awesome.
The feds might send you some checks, and we've all gotten used to checks coming in the mail, I guess, now. But the jobs tax credit right now is not refundable, unfortunately. But
the key here is that if you historically in the past 3 to 5 years, if you've added new employees and you've paid taxes in South Carolina, well, we can go back and amend those returns, and then you can generate a refund if you've already paid your income taxes. So if you're thinking now, oh man, I added 4 or 5 employees a few years ago, in that scenario, if you paid South Carolina income tax liability, you can amend your South Carolina returns and get refunds for the South Carolina taxes paid. So just keep that in mind. You're not out of you haven't lost anything if you've added employees in the past few years. You can certainly go back and amend. Just let us know, reach out to us, and we can walk you through those steps. We're running out of time. We've got about 20 minutes left. I know we want to leave time for Q&A, so I'm going to hop over to our checklist that Nick's going to give us rundown on, and then he's going to transition into the capital investment credit. But I think we'll probably pause before we start capital investment credit for any other questions.
Yeah, and here's a quick checklist, for you to take home. This would be a nice slide to keep and to questions to ask yourself. So we have gotten some questions, Will. So the first question was COVID related. If a company had layoffs early in COVID and is ready to begin adding new employees again, would they be eligible? How long do they need? So basically the calculation for the jobs tax credit is you look at your employee headcount at the end of each month. So there's a table, January through December. You calculate how many employees you had at the end of each month. And then assuming that your business was open for 12 months or it's operating for 12 months, you add all those employees up and then you divide it by 12. So if you lost jobs during the year, that's going to be, but then you added them towards the end of the year, that will somewhat average out. Obviously, there's specific facts and circumstances, and every business is different, whether based on their industry or how long they laid employees off and then rehired them, et cetera. But it's a monthly average calculation. Okay, all right, great. We just answered somebody else's questions there with that as well. Here's one, Will, we got. So I think we talked about this a little bit earlier, but if I currently have 1099 contractors but want to transition to W-2 employees, if the new W-2 jobs employees qualify, again, that is a yes. So your 1099 contractors, because they're not your employees, they're contractors, independent contractors, they don't qualify for the jobs tax credit, but if you convert them from a 1099 contractor to a W-2 employee, they count. Also, if you are using a PEO, a professional employment organization to staff your business right now, that basically means that there's a third party who your employees, your effective employees work for. If you then hire those employees from the PEO under your legal entity, your business, those employees can then qualify for the jobs tax credit as well. All right.
Nick, did you also see the one that says, does it matter if a business is physically located in Tier 1 county, but could hire someone in Tier 4 to work remotely? Would that or could that still qualify for tax credits at Tier 4?
Perfect. Yeah, thank you. I did miss that one. So that's a great question. I'm going to answer tentatively. Generally, it's where the business is located physically. So if the business is located physically in a Tier 4 county and you hire employees that are outside of Tier 4, but they need to report to you, whether they come because they come into the office every day, or because they're, they work remotely, but are required to come in once a week, or, have other duties that require them to come in on a regular basis, even if that's not, a daily basis. The physical location of the business is more going to be the determining factor of which tier credit you qualify for. So just by hiring an employee to work remotely in a tier 4 county, if your business is located in Greenville County or Richland County, that is not going to, in most circumstances, qualify that business for the tier 4 credit amount.
I agree with that one. All right. We had one on the 120% per county wage level. I think we've already addressed that one and covered that one. I think we addressed retroactive credits, didn't we, Nick?
Yeah, we've talked a little bit about retroactive credits, right? Well, go.
Yeah, retroactive credits were addressed. And finally, there's one on here. My bookkeeper accountant is a small business itself and has never mentioned these credits. How would you recommend that I stay aware of opportunities like the job tax credit? Well, it's hard, and unfortunately, small businesses and small CPA and accounting firms and bookkeepers, it's very hard because things are constantly changing, tax laws changing, incentives and credits are also changing. So, one resource is SBDC. I mean, that's how you sort of stay abreast of these things, and so we'll continue to build this relationship with Alan and his team. And, we're here to help. We're happy to help small businesses. We want to see y'all succeed. So please feel free to reach out to us, stay in touch. And, we're here to help you get through it. If we can't help you, we'll find somebody that can. All right, Nick, I think we're ready for you to take it away on the next part.
Perfect. Yeah, let's go ahead then. All right, so just, we'll quickly mention a few other credits that, you may be eligible for, and we'll also talk about property taxes real quick. But we did want to mention credit that's often overlooked. But if you are in a manufacturing type business, you could qualify for the South Carolina Capital Investment Credit. Basically, any manufacturing machinery and equipment that you purchase, depending on, qualifies for the credit, and depending on the depreciable life of the property, which is generally going to be 7 years for manufacturing machinery and equipment, you can receive a credit, which is 1.5% of whatever the cost of that, the cost basis of that asset is. So if you bought a $100,000 manufacturing piece of equipment, placed it into service, you could take a $1,500 credit on that, and that can eliminate up to 100% of your South Carolina income tax liability, and you can also carry that credit forward for up to 10 years. That's one that we just see is often overlooked in our manufacturing client base, even where companies are making either large or small purchases of M&E for their manufacturing facility, and they're not taking that credit, which 1 to 2.5% doesn't seem like a whole lot, but obviously every penny counts, and you can reduce your income tax credit very easily that way. All right, we're just going to kind of run through most of these. If you have any questions, feel free to reach out to us afterwards if you think you qualify. There's a corporate headquarter credit in South Carolina. So if you're establishing a corporate headquarter or expanding an existing one, you may be eligible for a credit. There is a jobs threshold and a capital investment threshold that you need to meet for that credit. The infrastructure credit, if you are doing any sort of developing and are doing any construction on a road that is going to be dedicated back to the county or the municipality that it's in, or if you're improving sewage lines, water lines, anything like that as part of that construction, you could potentially qualify for a credit based on the expenses that you put into that project. Fee in lieu of property taxes. I will take a minute here to talk about property taxes real quick. We're not going to get deep into property taxes. Obviously, this is the jobs tax credit webinar here, but Property taxes are very unfriendly in South Carolina. South Carolina has some of the worst business property taxes for your primary residence as an individual. Property taxes are great in South Carolina, but the way that they make them great for the individual homeowners on their primary residences in South Carolina is they have very high property taxes for businesses. If you are a business, maybe this isn't you right now, but maybe looking down the road in 2, 3, 5 years, looking to expand into a large facility, you need to have at least a $2.5 million investment in this facility. You should be thinking about negotiating ahead of time what's called a fee in lieu of property tax, or a FILO or a FILO. You might hear that term used. But basically what that does is it reduces your property taxes for a 30-year period generally by up to 40%, 40 to 50% really. It's a huge savings. Most businesses, that it's kind of like you have to do it, because otherwise if you're not negotiating a fee in lieu, if you're not thinking about reducing your property taxes, you're not going to be very competitive potentially, especially if you're a smaller business. If you're not, competing at the same level as your competitors, that's going to make, it can make it hard for you to be a going concern. That's something that's a discretionary benefit. Most of these other credits that we've talked about are a statutory incentive, meaning anybody that qualifies can apply for it on their tax return. Fee and lieu's are issued at the discretion of your county. So those discussions and planning opportunities need to take place before you purchase a building or you begin renovating or building a new facility. All right, there's also a number of real estate revitalization incentives. I'm not sure how applicable these are to most people on the call, but again, if you are purchasing old mills, textile mills in particular, any historic type structures, abandoned buildings that you were not the original owner of, and you're renovating those, you can get a pretty sizable credit for all your activity. And again, a lot of planning ahead of time. Forms need to be filed ahead of time in order for you to claim a lot of these credits. So if you're thinking about 2, 3, 5 years down the road, that you would like to purchase a building that's been abandoned, or you think you might move into one of these buildings and be doing significant improvements, talk to your tax planner, your CPA, etc. ahead of time, and make sure that they are on the same page with you, so that you can check all the boxes and make sure you're filing the correct forms, so that you can recoup a non-insignificant amount of your investment in that improvement. A few additional South Carolina tax. Yes, yeah, Yellen.
This is Alan. So I want to clarify, so I have a client here locally in Columbia that purchased a hotel, or is in the process of building a hotel that was an old armory. Mm-hmm. They got tax credits for that purchase, and they're reselling those tax credits in the secondary market, and they're getting real dollars. Do you see that happen a lot, where an entity might not necessarily need the tax credits and they resell them and get real dollars for them?
Absolutely right. So most of the credits that we've been discussing today are not eligible for resale. There's no secondary market for those. But these developer credits that are on this slide, I believe, except with the exception of the Brownfield cleanup credit, I believe the other three all have a secondary market. And so generally, these these credits are targeted towards developers of these sorts of buildings and sites. So, if they don't have a use for them, there's a secondary market. They can go sell those credits. Trying to think, maybe 65, 75 cents, something on the dollar.
75 to 80 cents on the dollar you can really get for them. And it's worthwhile if you can use it.
Exactly. So that is real money right there, and a great opportunity if you're doing any sort of that sort of thing.
All right, we got
I'll go over to you, I think, for the ER. Oh, I'll mention real quick the research expense credit. If you're doing R&D activity, and you qualify for the federal R&D research and development credit. South Carolina has a provision that basically piggybacks off of the federal credit. So if you know you are taking the federal R&D tax credit on your federal tax return, you should be able to claim a South Carolina credit for that as well.
Yep, absolutely. All right, I know we're getting short on time. Let's run through another minute or so, and I'll open it up for questions. Again, we'll make this presentation available, and we'll have Alan and his team have it. They can send it out if you need it, and we'll certainly have our contact information on the last slide. But let's knock out one more thing. If you haven't covered employee retention credits, there's a big thing that came out of the COVID relief packages, a number of modifications to employee retention credits, but basically, long story short, you can get credits for maintaining your employees, not laying them off, maintaining your employees. If you met one of two criteria, you either have to have had your business fully or partially suspended by government order. So a great example, hair salons, barbershops were shut down with an order from Governor McMaster back in, I'd say it was March or April of 2020. If you were one of those businesses, that would qualify you because you were partially shut down by government order. Same thing with restaurants. Restaurants were partially suspended by government order. If you were partially or fully suspended by government order, you would qualify if you maintain those employees, and you can receive a credit for those wages, credit of up to $10,000 for those wages paid. Other option to get you qualified, if your gross receipts in any quarter in 2020 are 50% or lower from the same quarter in 2019. So if you did really well in 2019 and your quarter, one of your quarters in 2020 is much lower due to COVID, if it's 50% lower, that would qualify you. Those wages paid, you get a credit up to $10,000 on those wages paid. 2021, again, there were modifications in Congress. So now all your gross receipts have to be lower than 20% in the same quarter in 2019. We're not comparing to 2020, we're comparing to 2019, pre-COVID. So if your first quarter 2021 were lower, 20% or lower than your first quarter in 2019, that would qualify you. You need to look into those employee retention credits. It's money left on the table, refundable credits on your federal payroll tax returns. Got to go after them, get all those dollars that are out there for you. Let us know. We have a team of experts at Elliott Davis that's handling these specifically for a number of our small businesses. We can help you with your amended payroll returns and or just preparing the calculations. So make sure you're looking into that. If you were either shut down by government order, or if you had gross receipts less than 50% than compared to 2019, or 20% compared from 2021 to 2019. I am going to wrap up. I see we had a question or two come in. What constitutes R&D? If the startup business is unique in nature and utilizing techniques that would be considered developmental or beta testing in nature, would that be considered R&D? Well, yes, that in general is R&D, but we got to get more in depth and detail. I mean, if you're doing developmental or testing, generally that, yes, is research and development, but obviously we need to get in the weeds and understand what is going on, how you're incurring those costs, and that type of thing. I don't know if you have anything else to add, Nick.
Yeah, just real quick. So the R&D credit is at a high level based on the wages that you're paying employees to do those activities. So if you have someone who's involved in developing a new process, products, designing or improving products, software, etc., the R&D credit would be based off the wages paid to that employee or that individual or that team. And generally, there's a process that you have to go through to kind of carve out their R&D activities if they're a mixed use employee, or if it's more of like you have an engineer whose sole job it is to design and improve products. That's a little bit easier. I'd be happy to discuss that afterwards.
Yep, sure. Certainly just shoot us an email and we'll help you walk through it. Nancy has a good question. Is ERC allowed if business received a PPP loan? Yes, you can now take the ERC if you got PPP. You just can't double dip on the same wages. There's some intricacies involved. You can't take ERC on wages that were paid using PPP money, basically is what it is. So if you kept some employees and you didn't use PPP money to keep those employees, you can take ERC on that. that's also something we can look into for you. We have some experts that handle that. I'm glad to point you in their direction if you want to look into that. Again, we're wrapping up right now. We have a minute left. Got really close to the end. We appreciate everybody coming on here, attending. Please reach out to myself and Nick. We specialize in state and local credits and incentives with Elliott Davis. We are the state and local tax practice in South Carolina, the main one in South Carolina that covers this type of material. We're happy to hop on any other presentations and webcasts and help you in your groups. We want to make sure you're aware of these credits. Small businesses are missing these credits every day, and it's a shame. And we got to take advantage of them because it's money sitting on the table that help you grow your business and do big things that you're dreaming. So with that, I just want to say thank you.
And one last thing for the audience, if you could please, we will be sending out a post-event survey. You will be receiving that shortly after this presentation ends. Those individuals who reply to the post-event survey will receive these presentation slides on Tuesday, which is January the 6th. And we also hope by that time that the webinar will be posted on our site, so we can send you the link to that. And I'll also be sending out the link to session 1 and session 2 for those of you who may have missed it or might be interested. So thank you very much, Nick and Will, you've been most helpful. Alan, did you have anything in closing? I don't believe so.
Yeah.
Oh,
Okay,
Alan,
would
thank
you let me share my screen right quick? All right, so then, hold on. Bear with me. All right, so is everyone seeing my screen?
We see all of your slides.
All right. So again, just want to thank you, Nick, Will, for the presentation today. Carolyn already mentioned slides and video. What I really want to point out is that there's one more session remaining in the series, and that's next Wednesday at 12 p.m. We're going to be talking about maintaining good well-being to drive your business and recruit good talent. And so if you haven't registered for that session, please go ahead and register and share the information with your peers in the local marketplace about the SBDC. I will say also, if you're not quite sure where to start with those credits, to reach out to the SBDC, reach out to your local consultant, and they can point you in the right direction. We are not CPAs, accountants, or attorneys, but we do have local resource partners that can help you. So I'd like to say thank you for the committee. Thank you to the committee, Katrina Mix out of the Clemson region, Gary Robinson out of the South Carolina State region, and Ben Greenswig out of Winthrop for the work that they're doing to get you information on HR issues and problems that you might be having and solutions that you can take advantage of. We understand that raising talent is just as good as raising capital, and we want to see you succeed through COVID-19. So thank you again, and have a great day.